Okay, get us into slideshow. Okay, so as we get into chapter 17 here now, we are going to start to pick up some of the tax consequences for what we're going to be calling C corporations. That's subchapter C of the tax code, and then we'll do S corporations and partnerships later. Okay, so we already studied the formation of the corporations chapter 18, and now we're going to see that some of the tax accounting for corporations is similar in many ways to what we've talked about for individuals, at least in terms of broad categories of tax consequence, but the treatment of things such as charitable deductions, how dividends received are treated, are going to be a little bit different for corporations. Okay, so I think some of this stuff we already know. For example, if we're talking about a sole proprietorship, okay, that's going to be obviously not a corporation, right? And one of the main problems of a sole proprietorship, well, just from a tax standpoint, we would go ahead and we would put our information on Schedule C, and then whatever the taxable income flows through the 1040. And we talked a little bit about that and talked a little bit about some of the tax deductions for for sole proprietorships, businesses, etc. Okay, if we're talking about partnership, then what? Then we will use Form 1065, and the deal there, and we'll study this more later, is that with partnerships, the income flows through, as it does for just looking at S corporations. Income flows through to the partners, to the shareholders in the case of an S corporation. So we'll get to partnerships and S corporations a little bit later. We're going to be spending our time, not today, but in another chapter. What we're going to be spending our time today is with C corporations, named after subchapter C of the tax code. That's why they call them C corporations as opposed to S corporations. Hello, our subchapter S. Okay, so what happens? We talk about this concept of double taxation. Why are they saying this? The C corporation is treated as a separate legal entity. So we'll see that the C corporation will file a Form 1120, and they will have to pay tax on that income. Now, where do we get into this idea of double taxation? Well, at the same time, the corporation pays the tax. If there are any distributions to the shareholders in the form of dividend, then they will also pay tax on those dividends. And so you pay tax on what? On the original income, but then the income goes to retained earnings, and then retained earnings, we pay our dividends out of that, and then the recipients have to pay the tax on the dividend. Okay, so they call that double taxation. Now they have tried to alleviate that a little bit in that Congress does what? The dividend, by the way, is not an expense. Dividend is never expense, right? I sometimes have to remind my introductory to accounting students. They start trying to think of a dividend as expense. I tell them, well, it has the same effect on retained earnings as an expense, but it's not reported on the income statement as an expense. And the dividend paid by the corporation is not therefore deductible for tax purposes, right? It is not an expense. It is not deductible for tax purposes. So that's how we end up the double taxation. I already paid tax on that income at the corporate level. Then when I distribute those earnings out to my shareholders, they have to pay tax on it again. So what they've done, and we learned this in an earlier chapter to try to alleviate some of the double taxation burden, is to go ahead and create a situation where they have lower tax rates. And we're not going to get into this in this chapter. We've already studied this. It's pretty much flows along with what we had talked about with the capital gains rates before. They tax those dividends at certain beneficial rates. Okay. All right, so that's just sort of a quick blurb of where we're going here with the C corporations, and we're going to be seeing that there are some things that are different about corporations, and of course, we're mostly interested in what? In the tax rates. Okay, now you see the 2017 tax rates, and I just pulled this right out of, I think this was in this chapter, but then I went back and said, oh yeah, we had the big Tax Cut Jobs Act, Tax Cut and Jobs Act. I hear everybody still calling that tax reform, and every time I'm like, don't call it tax reform, because it's not tax reform. It's Tax Cut and Jobs Act is the way to refer to it. But you can see they've lowered that rate significantly from the upper rate of 35%, 39%, down to this 21%. Okay, good. Now, just a couple of things which I think you knew already, but of course, corporations have what? Have limited liability. Sole proprietorships have full liability, right? The owners are personally liable for anything that happens in the corporation. So if you have a barber shop and you accidentally cut somebody while you're doing the work, or you're cutting their hair, they can come and take your house, right? So what do? You form a corporation, so they may take your business away from you, but they can't come and take your house, your car, your personal assets, etc., right? Okay. Obviously, we have the advantage of raising capital when we're in corporation. All we have to do is what? Not necessarily go through any kind of formal borrowing process. We simply issue the shares of stock in exchange for cash, right? There is also ease and transferability. What happens? I have a business. I have all this equipment and stuff that I put into the business. I get stock in exchange, and then if I decide, you know what, I don't want to do this anymore, I just simply go and do what? Sell the stock to somebody else that's willing to take over that business. We're done, right? And I can walk away with whatever cash I get out of that. Continuity of life. For partnerships and for sole proprietorships, if you dissolve those entities, or you have a partner exit, or one of the sole proprietor dies, or one of the partner dies or something, the old business ceases to exist, right? And we start up a new business at that point in time. With the corporation, everything keeps going. Of course, if the guy with all the ideas dies, I guess, that's the end of that. But hopefully, or lady with all the ideas, but hopefully, there'll be some sort of, they call it continuity planning, so that the corporation will be able to continue, right? Okay. Then what? Centralized management, right? Corporation, you own shares in a corporation. It's almost like watching a football game, right? And that you don't necessarily have control over the management decisions. You may have others making those decisions. So you may be sitting there saying, no, don't throw the ball, run it. They'll run it anyway, right? Or they'll throw it anyway, right? And so you're more of a spectator than you are participating in the management. All right. So I think some things you knew when you walked in here. So let's just go ahead and take a look at what we'll be doing here with our corporate versus individual, and some of these things are similar. Exclusions, income broadly defined, very similar. Remember, everything is included in income unless excluded. Okay, so it works very much the same there. Where we start to get into things that we're going to be studying more here in this chapter is if we have the deductions for net operating loss and dividend received deduction. They give us certain beneficial, what is that? They give us certain beneficial things that we can do here if we're receiving dividends. Really? Well, what is that? I don't know what happened there. I was just trying to change the color to yellow. Okay, so we have what? We have the net operating loss and dividends received deductions, and we're going to get into those. Those are things that are not necessarily available as itemized deductions, etc., for individuals. Okay, and then we will still have our taxable income, our tax credits, etc., and then you have either the amount due or refund. Those are very similar. So what we're really going to be seeing is some of these deductions are different for the corporations, and that's what we're going to be focusing on as we go through this chapter. Okay, good. So let's see which ones we're going to focus on, and we'll talk a little bit of accounting periods and methods. There are different rules for corporations for capital gains and losses. We'll talk a little bit about passive losses. We'll talk about charitable contributions. We'll talk about how we handle net operating losses. And then special deductions available only to corporations. That sounds like more than it is. We'll talk about things like startup costs, those sort of things, and how we're going to treat those, which obviously are not relevant for individuals. Okay, so let's just go ahead and take a look at accounting methods. And a corporation may choose a calendar year or a fiscal year, and often corporations will choose fiscal years that correspond with the activity in their business. So if you look at CPA firms, a lot of times they'll choose a June 30th fiscal year and July 1st start, because that gives them enough time to have done what? Gone through their busy season, their tax season, their recruiting seasons, all that sort of stuff. That's why they're always in a hurry to get you on board by a certain date, June 30th, and they cut it off and all that. And so they would probably have choose a fiscal year going from July 1st to June 30th. Could be a calendar year. Okay. Now, corporations need to follow accrual basis. Okay, cash basis is unavailable unless you are one of these entities: S corporations, smaller C corporations, qualified PCS. PCS is personal service corporations, such as accounting firms, that sort of thing. They can use they can use cash basis. Everybody else is going to be using accrual basis. And we're going to be focusing on the C corporations in this chapter that are going to be using the accrual basis. Now, what happens here? Okay, can a corporation using the accrual basis must observe a special rule in dealing with cash basis, and key phrase here is cash basis related parties. Okay, so we're worried about this when we have related parties. Now, the reason they're focusing on related parties is they don't want something being engineered where there's some sort of tax benefit that they can arrange as to when the payment is actually made. So they look at with related parties, and we say that if a corporation has an accrual outstanding at the end of the taxable year with the related parties. So what does that mean? They are going to go ahead and debit the expense and credit a payable at the end of the year, right? They say that it cannot claim a deduction until the related party reports the amount as income. So they're saying, hey, look, if the individual that's related to you is going to report that as income in 2018, even though you might have accrued an expense at the end of 2017, you can't take that as a deduction until what? 2018, because that individual is not going to include it in their income until 2018. Okay? Now, they give us a rule there. To be considered related, it really has to, the individual has to own 50%. More than 50% of the corporation's stock. Okay. However, in the case of a personal service corporation, any shareholder employee is treated as a related party. Okay, so 50%, unless it's a personal service corporation, then any shareholder employee is treated as a related person for these purposes. Okay, PCS organizations, personal service corporations. Fields like health, law, engineering, accounting, etc. Okay, don't worry. You know, the questions that we're going to be looking at, it'll call out, is it a personal service corporation or not? So I'm not going to expect you to be guessing as to whether it's a PCS. Okay, okay. Now, you take a look, and it's considered a personal service corporation where more than 10% of the stock is held by a shareholder employee. Then we're going to consider that a personal service corporation. It has to meet all of these criteria. Okay, but again, I'll tell you up front what it is. But just let's look at this Samantha, a cash method taxpayer who owns 100% of the corporation's stock at the end of 2017. I guess we're assuming this is not a personal service corporation because they bothered to call out the percentage, right? And so that makes it It's that she has obviously more than 50%. On December 31st, 2017, Skylark Bakery has accrued a $10,000 bonus to Samantha. So they debited some sort of compensation expense for $10,000, credited the payable, right? Okay. But what happens? She doesn't receive the payment of the bonus until 2018, and therefore will report that as income on her 2018 returns, and she's a cash basis taxpayer. Therefore, Skylark, even though they are an accrual basis taxpayer, cannot claim the deduction until 2018 because this Samantha is not going to report it in her income until 2018. Okay? So pretty easy rule to remember. Pretty fun thing to, if you're sitting around bored and you want to, think about these kind of things, you could write your own little questions like this, right? And just have some fun with that, okay? So let's just go ahead and let's take a look, though, at something. And by the way, as you know, don't forget, I post the file up there in a separate Word file, okay, so that you have that, and that allows you to manipulate and hide the answers and all that kind of stuff for study purposes. And as I said, I'm going to deploy the homework through Canvas out of Cengage now here for the chapters, and I pretty much dump everything. I give you practically the whole test bank, right, and all the homework, so that'll be coming here probably tomorrow. I don't think I'll be able to get to it today, but I'll be able to do that a little bit tomorrow. Okay, so Ivory Corporation, a calendar year accrual method. C Corporation has two cash method calendar year shareholders who are unrelated to each other. And I'm like, who cares if they're unrelated to each other? Are they related to the corporation? Well, Craig owns what? 35% of the stock, and Oscar owns 65%. So what happens? Craig is not related to the corporation. Oscar is, right? Because he went past the 50%. So Ivory paid salary of $100,000 to each shareholder. On December 31st, 2017, Ivory accrued a bonus of $25,000 to each shareholder. Assume the bonuses are paid to the shareholders on February 2nd, 2018. Compute Ivory's Corporation's 2017 deduction. Well, let's deal with the easy one first. This $100,000 to each shareholder got paid in 2017, so it obviously is what? A deduction for 2017? Because it was paid in 2017? Right? Okay, so that's 100,000 plus 100,000. And then they accrued the bonuses. They debited some sort of compensation expense, credited bonuses payable, right? Assuming the bonuses are paid in 2018, well, what happens? Oscar is the related one, right? Craig is not. So we can pick up what? Craig's bonus? How do you spell Craig? C-R-A-I-G. Craig's bonus, yes, of $25,000. How about Oscar's? Not Oscar's because what? Oscar is related. So when you add that up, that comes to the $225,000 shown as choice B here. And you can't take not Oscar. Sorry, Oscar. Well, Oscar doesn't care, right? Because he got his money and he's going to declare it in 2018. Sorry, Ivory, because you can't take Oscars, right? Okay. All right. Okay, so not too bad. All right, let's go ahead and let's take a look at capital gains. Now, just quickly reviewing what we learned back in chapter 2. Remember when you were young and we were still doing this stuff? Okay, back in chapter 2. And back in chapter 2, we said that you would do what? You would basically net your capital gains, capital losses, and if you had net short-term capital gains, that was ordinary income subject to regular tax. And then if you had what? Net long-term capital gains, right? For our gains, they gave us a special rate there, didn't they? The 20% rate, okay? If we were sitting here and we were dealing with losses, they would limit the amount of loss that we could take up to $3,000. And this is just a review of the rules. And we could carry those over into future years, and they would maintain their identities, either short-term or long-term, whatever they were, right? After we netted against our short-term and our long-term gains and losses, any losses that were in excess of 3,000 got carried forward. Okay, so that was what we learned back in whatever chapter it was. And just looking at this example of how the individuals work, Robin, an individual, incurs net long-term capital losses of $7,500 for 2017. Assuming she has adequate taxable income, she can deduct what? $3,000 of that loss using the $3,000 limitation for individuals, meaning that she would have $4,500 that she would then carry forward to 2018 in future years, and it would maintain its identity as a long-term capital loss in this example, right? Okay. Now, what happens? You come over, and for corporations, if you have what? If you have a gain, there is no special rates. So whatever the corporate rate is, that's what they pay on gains. Now you look at that and you say, wow, that's pretty harsh. Except when you look to what they just do, what they're going to do in 2018 with capital rates, they lower. With corporate rates, they lowered them, so they're actually getting about the individual's rate on the capital gains. Okay, so gains, there's no special rates though. Okay, now a corporation cannot take a loss though. Corporation cannot take a loss for a net capital loss in the current year. Okay, so let's just put that as current year, because we're going to see that they're going to let them carry it back and forward. But whatever the loss is in the current year, they cannot take that. So never take the loss in the year that it was incurred. That never happens. It's either going to do what? It's either going to go back or it's going to go forward. But you don't take it in the current year. Okay, so capital losses, well, I'm saying that if you have a net capital losses can be used to offset capital gains. That you can do in the current year. But if you have a net capital loss, you cannot take that in this year. You could either carry it back or carry it forward. Okay, if you have unused capital losses, therefore, that weren't used to net out capital gains, you can carry them back for 3 years, forward for 5 years. Okay, and they say all carried over losses are treated as short term. Now this gets a little confusing. If you sit there and you say, well, is there a difference in the treatment between short term and long term? And the answer is no. Everything is taxed at the what? At the corporate rate. So you're saying, well, why do they call out short term and long term? Well, it used to be that the tax code had special treatments for short and long term for corporations. And so they removed the special rates for short and long term, but they left the designation of short and long term in case they decided later that they wanted to put back the preferable rates. It would be easier for them just to insert the rates again back into their short and long term provisions or whatever. So it's a little bit of a weird thing that Congress did with the law just to annoy us. Okay, so at the end of the day, everything is taxed at what? The corporate rate, whatever it is, below 20% coming up here, regardless of whether it's short term or long term. Okay, so let's take a look at Robin again. And none of the $7,500 net capital loss that she had incurred in 2017 can be deducted in 2017, right? You can never take the net loss in the period of loss. Robin, however, let's see what they do let her do. She, however, may carry back to 2014, 15, 16 in that order, guys. You go in chronological order when you do these. So it's in that order and offset it against any capital gains in those years. Okay? If the carryback does not exhaust the loss, then it can be carried forward and it goes in chronological order: 2018, 2019, 2020, 2021, 2022. How many years? 5 years forward. 3 years back, 5 years forward. Okay? And it'll be treated as short term, and again, all that means is what? Taxed at the regular corporate rate. There is no special, preferential rate for long term like you see, like there used to be for corporations and like you see for individuals. Okay? All right, so let's go ahead and let's take a look here. And we have this Elk Corporation. $370,000 of operating income, $290,000 of operating expenses. Clearly, whoever's writing these questions is not a financial accountant, because we don't call revenue operating income, right? Operating income is what's left over, revenue minus expenses, right? So this is a little annoying here. This should be called what? Revenue, okay? But they called it operating income, okay? So we have what? Revenue of $290, expenses of what? Revenue of what? $370, expenses of $290, and then they have this $10,000 long-term capital gain and a $17,000 short-term capital loss. So what do? We are able to eliminate this $10,000 capital gain down to zero by using what? By using $10,000 of this loss. So it zeroes out, right? Okay. Then we have what? We have $7,000 net capital loss here. Can we do anything with that this year? We cannot. We can only do what? Either carry it back or forward. And since this question is asking me what? For 2017, then I have taxable income here in this year. What year is it? They don't give me the year, but for this year, what is the taxable income? And so it's simply what? The $370,000 minus the expenses of $290,000 gives me what? $80,000. Okay. Now, what are they going to do with that $7,000? Either carry it back or forward. It does not affect this year, right? Okay. All right. Good. Let's take a look at this question. It gets a little bit more involved with what you do with the carry backs and forward. Okay. But we've got this Carrot Corporation, a C corporation, has a short-term capital gain of $65,000 and net long-term capital losses of $250 during 2017. The period. Carrot Corporation has taxable income from other sources of $720,000. I think that number is. I got my cursor in a funky spot there. And then prior years' transactions include the following, okay? And compute the amount of Carol's capital loss carryover for 2018. So what happens? Well, first we net what? We net our capital losses against our capital gains, right? So we've got $185,000 loss left that we can do what? We can carry back for 3 years, can't we? Okay, so if we're sitting here and it's 2017, we can pick up 16, we can pick up 15, we can pick up 14. Oops, not 13, because that's more than 3 years, right? So we go ahead and we back those off. 60 would be the carry back for 14, and we have to go in that order. 15 would be the carry back for 45 would be the carry back for 15, and 35 the carry back for 16. So we're left with what? We're left with we have total carrybacks of 140. So 185 minus the 140 means we have what? 45,000, which could then be carried over to what? 2018, 2019, 2021, 2022, etc. We can carry those forward 5 years. Okay, so the amount of a loss to carry over to the next year, 2018, we've got what? 45,000 left. Okay. So we had the what? We had the net. We had a net loss of 185, and then we carried it back 3. That left what? 45,000 that we could carry forward, right? Okay. All right, good. Question on that? Okay. I want to look at one thing here. Yeah, okay, back 3, right? Okay. All right, so let's just go ahead and let's take a look. And I will expect you to know, by the way, guys, how many years back 3, forward 5. I mean, that's something, just, you know, and you'll have your notes, but that's something I expect you to know. Okay, passive activity losses. A little bit more of a favorable treatment for the corporations in that what? With our passive activity, we couldn't back them off of what? For individuals, we weren't allowed to back them off against our active or our portfolio income. So we could take passive activity losses against passive activity gains, but we could not write off passive activity losses against our active and our portfolio income. Remember that, right? Okay. S corporations, since the income flows through to the shareholders, they just follow the same passive activities rules as individuals were that we talked about a couple chapters ago. Okay. Now, here's why it's a little bit more favorable for my corporations, and that they will allow them to do what? Closely held. Closely held means more than 50% of the stock is held by 5 or fewer individuals, and it's not a personal service corporation. Okay. So you can see that there's what we mean by closely held. But closely held corporations may offset passive losses against active income. Well, thank you very much. So now we can go ahead and take the passive losses against active income. Individuals don't have this option, right? And then just like individuals, closely held C corporations, they are not going to allow them to write it off against portfolio income. So that's just like individuals there. Okay, so you take a look at this example. This is a pretty nice example, I guess. Brown, a closely held C corporation, and by the way, I would call that out as closely held. I probably wouldn't have you guessing here. The closely held or not, I'd call it out as such, and it's not a personal service corporation, because personal service corporations don't have this option, period, right? Okay, has 300,000 of passive activity losses from rental activity, 200,000 of net income, and 100,000 of portfolio income. The corporation may offset what? This is the solution here. May offset 200,000 of the 300,000 passive activity loss against the 200,000 of what? Net active income. So they're essentially going to reduce that net active income down to 0, aren't they? With this passive activity loss. They cannot use any of the passive activity loss against their portfolio income. That's just like individuals. Okay. All right. So let's just go ahead and take a look at this question from the quiz. Gerby Corporation, a closely held corporation that is not a personal service corporation, had 75,000 of net active income, 60,000 of portfolio income, and what? 105,000 of passive activity loss. How much of the passive activity loss can Gerby deduct in the current year? And it's what? 75,000 against the active income, right? Nothing against the portfolio income. Okay. Okay, good. Let's take a look at charitable contributions. Just like individuals, charitable corporations are going to have certain limitations of their deductions. So your guys' favorite subject, right? Charitable contributions. Okay, so here we go again. We're going to have certain limitations against that. Okay, so both corporate and non-corporate taxpayers, we know that. Exception for accrual basis corporation allows what? Exception for accrual basis allows deduction in the year preceding the payment. So this is pretty good. I'm a corporation, and I'm thinking, hey, social responsibility, right? We have to think about that. And so I'm sitting there, and I come to the end of the year, I haven't made my charitable contribution yet. Then I go and I prepare my tax return, which says is going to be due April 15th. And I don't like the outcome. And I'm sitting there saying, any way I can reduce this tax? And the answer is yes. Make a charitable contribution before you have to file the tax return. You can deduct that in the previous year. So if it was 2018, we're getting ready to do our taxes here in a few days. We don't like what we're going to have to pay. We could what? Alleviate some of that by making a charitable contribution in 2018 and deducting it what? In 2017, right? Okay. So it has to be authorized by the board of directors. And we would have to make that what? Payment to the not-for-profit, whatever, the charitable entity, what? On the 15th day of the 4 months following the close of the taxable year. So let's just make that easy. Assume a calendar year taxpayer, they'd have to make it by April 15th, right? Okay. All right. So generally now the deduction of property, okay, we'll start talking about property, results in a deduction equal to the property's fair market value at the date of the gift. So that's pretty good too, and that we get to use what? Fair market value. Now, this is a tax planning advice here more than anything. Well, I don't know if I want to say more than anything. It's a tax planning consideration, though. And the reason I say that is we're going to look at a question from the quiz in a minute in which they're going to sort of ignore this good advice that's about to come up. So it's not like this is a law that you have to follow. They're just saying, hey, you probably would want to do it the way we're going to describe in the example that's coming up to get the maximum tax benefit. But there's no law that says you have to do it this way. Okay? But let's take a look. They tell us as a result, a contribution of lost property, fair value is less than basis, should be avoided. Instead, the lost property should be sold, allowing the loss to be recognized, and then what? And then the proceeds contributed to the charity, so you get to deduct what? You get to deduct the loss, and you get to deduct the contribution, right? And so you get a better tax outcome. So let's just look at this example. Heron Corporation owns inventory with a basis of $10,000, fair value of $8,000. A charitable contribution under the inventory results in a deduction of what? $8,000, because we are supposed to be using the fair value. It's lost property. You just go to whatever the fair value is, right? It's $8,000. Okay. However, if I sold the inventory for $8,000, if its basis is what, $10,000, I get to take a loss of $2,000, and then I just take what? Then I just take that $8,000 and donate that to the charity. Now I have a deduction of what? $10,000, the loss plus the what? Contribution of the cash that I gave for the for this proceeds from the sale. Okay, so a little better outcome. So you really shouldn't deduct. Shouldn't contribute lost property. Sell the property and then just give the money to the charity, right? And you get to deduct the loss as well. Okay, now you take a look, and amount deductible for property contribution depends on the type of property contributed. Long-term capital gain, the deduction is what? Fair value. Exception. If we go ahead and we donate the property and it's not used by the charity in its exempt function, then I have to use the basis. So in these two examples, they donated a painting to a museum and the museum hung the painting. Are they using it in their charitable designation? Yeah, they're a museum, they're hanging paintings, right? So it makes sense. So I would be able to use fair value in that case. If the charity, the museum, takes the painting and sells the painting for cash, they're not going to be hanging the cash on the wall. So that's not what? That's not in their charter, and so I would only be allowed to deduct the basis under those circumstances, right? Okay, so they have to use it in their whatever their purpose is in order for me to be able to use fair value. Otherwise, I got to use the basis. Okay, now you come over, and the other exception is if the deduction for property is contributed to one of these private non-operating foundations, then we're limited to basis. Okay, so a couple exceptions, but pretty much we're able to use what? Fair value on this, right? Now you come over and we have ordinary income property. Ordinary income property is going to be what? Inventory stock. Pretty much it's the rule that it is held for less than 12 months is the issue that makes it ordinary. Okay, and if it is ordinary, then we are going to be limited to our basis. Okay. Okay, with me so far? Ordinary income, not long-term property, we're going to use basis, right? Okay, and then what makes it ordinary? Less than 12 months. But they provide a small exception here, okay? And the exception is what happens if I'm Nordstrom and I give a bunch of clothes to the poor, to the clothless. Okay, to people that need clothes, whatever. I give a bunch of clothes away. Well, at that point, I'm giving up inventory that is going to help, say, a child organization or something like that. And if that's the case, then they will let me use these formulas that you see here, such as inventory. Okay. Such as inventory on certain contributions, inventory to corporations, however, the amount of deduction is equal to the lesser of the sum of the property's basis plus 50%, or twice the property's basis, whichever is the lesser, I can take that. Okay. Now, in order to qualify for this, it has to go to a charitable contribution who exempt purposes for the care, ill, needy, infants. Okay, a contribution of what? Has to be contribution of tangible, or it could be contribution of tangible research property to a qualified educational scientific organization, etc. Okay, so if I'm giving inventory to one of these type of qualified organizations, what are they going to do? They'll let me take a little bit more than basis, right? Basis plus half of the increase, or what? Double half the difference between the basis and the fair value, or double the basis, whichever is the lesser amount. Okay, and so you take a look and look at this example, and you see this is pretty easy. Clark Corporation, a clothing retailer, donated children's clothing to the Salvation Army to be used to attire homeless children. And I thought to myself, how about we give them a home? I mean, they're homeless children. Geez, those are the best dressed homeless children I've ever seen. I mean, maybe they need a home more than they need shelter. They need shelter more than they need clothing. But anyway, so they go ahead and they're giving them some clothing. Now, Lark's basis in the clothes is $2,000. Fair value is $3. What is Lark's deduction? Now you take a look, and they've given us the answer here as $2,500. Okay, and they came up with $2,500, the basis plus half the what? Difference between the fair value in the basis, and that is going to be less than what? Double the basis. Double the basis would be $4,000, wouldn't it? So we take the lesser. Now they come over here and they say, well, what if instead Lark's deduction, the fair market value, I should say $7,000, then they say Lark's deduction would be the $4,000 in that case. So you take a look, and let's just see how we made sure that that was less than the basis, which is what, $2,000 plus what, half the difference, and the difference here is what, is the $7,000 now, changing the fact pattern, minus what? Minus the basis, which is assuming is still 2,000, and it's 50% of that, right? Okay, so 2,000 plus 0.5 of what? 5,000 is going to be 2,000 plus what? 4,500? I mean, 2,500. And so that is what? That is going to be 4,500. So the 4,000 twice the basis is the smaller amount, right? And so we take the 4,000. Okay. All right, good. Now, after you've calculated what they can contribute, fair value or basis for ordinary income items, or if it's these special inventory items, the formulas that we just talked about, then you're still going to be limited to 10% of taxable income. Now, when they talk about taxable income, they make you start adding back certain deductions that you would be taking for taxable income. So they're going to what? Bring your taxable income up above the true taxable income in order to calculate this 10% limitation. So charitable contribution deduction, net operating loss, or capital, net operating loss we'll talk about here in a little while, so don't worry. What is NOL? We'll get to that in a while. We haven't talked about that yet. Or capital loss carryback, we talked about already. Dividend received deduction, we'll talk about later. Domestic production activities deduction, guys, I'm not going to cover in our discussion. That was something that was put in, during the Obama administration, trying to get the economy sort of back and percolating. And so I'm not going to get necessarily into that one. But if you did have that, you have to add that back, okay? Now, if you have contributions following the rules that we've talked about made in excess of 10%, you can carry those forward, but you can only carry them forward for 5 years. 5 years only, okay? So we start to look at this example, and we've got income from operations. We've got our expenses from operations, and again, that's annoying. Revenue, essentially, from operations, and then we've got our expenses, okay? We've got dividends received and charitable contributions made in May 2017, 6,000, okay? So what do? We go ahead and we're trying to figure out our limitation here, and when we look at our income from operations, it's 140. We have what? We have the 110 expenses from operation, and then we've got dividends received of 10,000. So when we look at all that, we add that up, we come up with what? We come up with 40,000, okay? Times what? Times 10% means that we have this what? This $4,000 is the limit of what we can take, okay? And so when we take that 4,000, then 4,000 times is our limit, and so we can only deduct what? That, and we take that off of the what? Off of the 6,000, and that means we only have 2,000. We have 2,000 left that we can carry forward. Okay, so we can take up to that 4,000. Okay. One thing that makes these a little bit tricky is you look at that 6,000 and you say, well, why didn't we add the 6,000 back? Well, the 6,000 is not part of our expenses from operations, is it? So you would need to basically just ignore that 6,000. Don't deduct it. Just leave it alone, right? But you'd have to put back your dividend received, because dividend received is part of the income that has come in from the operation. So those get a little bit tricky, as to make sure you don't add back the contribution, because that's not an accounting deduction, is it? And so we would have to go ahead and not basically ignore that, is the way you do that. Now, if you look at the same facts in example 20, 2018, Orange Corporation has taxable income for purposes of the 10% limitation of 50,000. So we're going now into the next year, right? And makes charitable contribution of 4,500. The maximum deduction then is 5,000. Well, how are we going to get 5,000? $4,500 from the current year that's being contributed, plus what? 5,000 of our carryover, right, into the next year. I'm not 5,000, but 500 of our carryover into the next year. Because we would have had, what, 2,000 available? Okay, so we can take that carryover into that next year. Okay, let's go ahead and let's take a look at a couple of questions here on these subjects and on this charitable contribution thing. And we've got these different amounts. 100,000 of clothing to Haven for Hope. That sounds like one of those qualified organizations, right? Where we're going to take a little bit more than, be able to take more than the basis. Then you've got what? Stock in Exxon Corporation, held as an investment to Citi. And what happens? This is lost property, isn't it? And so they went ahead and ignored their own advice from the in this solution from what they said earlier. We said earlier they should do what? Sell the stock, get what? Get the sell the stock, get a loss of what? 2,000 on that, and then take the proceeds and donate the proceeds, which would be what? This $3,000, so they get a bigger loss that way, don't they, or a bigger deduction that way? Okay, but the solution to this problem ignores that advice. Okay, so we're going to go ahead and we're going to pick up what? We're going to pick up the lower fair value. Okay, and then what? Then we've got this one, which is land acquired 4 years ago, so it's meeting the requirements of long-term capital. And we are able to pick up the fair value here of 75,000, right? Now, so far we've got that 3, we got that 75. How did they come up with this 12.5? Well, to come up with the 12.5, they're going to go ahead and take what? Take the 10,000 basis plus what? Plus half the appreciation, 50%. Of the appreciation of 5,000 right there brings us to this 12.5, right? Take the basis plus half the appreciation. Appreciation is the difference between the basis and the fair value, right? And we take half of that and add that to the basis. That gives us the amount that they can deduct, as long as that is less than what? Double the basis. Well, if you take the basis on this children's clothing, 10,000 times 2 is what? 20,000. So 12.5 is way below 20,000, isn't it? Okay, so we would go ahead and pick up that 12.5, and so we could deduct 90,500 here. Okay. All right, good. Let's take a look at this one, and we have what? Again, income from operations. Very annoying that they keep calling that income instead of revenue or whatever, but they got income from operations, and then they have what? The dividends received, and we have to add that back for purposes of determining our limit, don't we? Dividends received deduction, we don't get to take that, so we go ahead and we add that back. Now, they tell you that it's a 15% ownership here, and right now that doesn't mean anything to us because we haven't talked about the dividends received deduction. So we're just going to go ahead and take that 15,000 and add it back. That gives us a subtotal less our expenses. Our expenses were 140, so we have our limitation is what? 75,000. 75,000 times is the base for the limitation times the 10% means we can deduct 7,500. Now they had what? 9,000 of deductions, but they are limited to this 7,500, aren't they? And so B is the correct answer. Now, the other thing that gets confusing here, and this happens, you see the domestic production activities deduction? That deduction, we've already taken those expenses out as operating expenses, and so we would not have to add that one back. That's already going to be included in our expense for operations, so we don't have to add that back. Okay. All right. So that would be our limitation. Then, of course, we could carry forward these remaining, whatever it is, 1,500. Okay, all right. Come over and let's take a look at net operating losses. Now, here's what happens. We're sitting here, we're a corporation, we're losing money in the early years, and then all of a sudden, we start making money in the future, and we say, geez, we lost all that potential tax benefit of all those times that we could have, basically had those losses and saved some tax. So they take pity on us, Congress does, and they say, okay, no problem. We'll let you carry those losses that you couldn't take in previous years, and we'll let you carry them forward. Now, the other people that they're trying to help are those that have maybe been successful and then are all of a sudden having what? Having a bad year. They'll let them carry some of those net operating losses back. Okay, so they can be carried back, and you need to know the time here, period. 20 years, carried back 2 years and carried forward what? 20 years. Okay, now when we calculate the amount that is going to be included, the dividends received deduction is allowed to figure out whether or not we have a net operating loss or not, and we'll get into the dividends received deductions here in a little while. Okay, if we don't get to it today, we'll get to it next time. Okay, so let's just go ahead and let's take a look at how we would calculate the carry forward, carry back. So we have what? Gross income, including dividends, of $200,000, less business deductions of $300,000, and then they also let me take the dividends received deduction. Now, if you're looking at that 70% and saying, well, why 70%? 70% is the amount that's allowed for the dividends received deduction if you own less than 15% or less of the stock, and they're below that 15%, and that's why they use 70. If they were above that 15%, they would use 80, and then they go even higher, they get to deduct some additional percentages. So don't worry about that right now. We'll understand those percentages later. Okay. So what happens? We have this 200,000 minus the 370 means they have a taxable here, and it is a what? Loss of 170. And so what happens? It can be carried back 2 years, and since this is 17, they can carry it back 16, 15, right? Now they have to first carry it back to 15. And so what happens? Since they had income of 40,000 in 15, then they can go ahead and do what? Completely get rid of their taxable income from 2015 and still have what? 130,000 left over, and the problem didn't tell us what their 16 income was, but they can apply that to 16 going back to 2 years, and then if there's still an amount left over, they can do what? They can carry that forward to 18 and so on, right? Okay. Now they literally get a refund from those previous years, because presumably if they had 40,000 taxable income in 2015, whatever, they paid tax on that, right? So they literally will get a refund for that money that they had paid previously. Okay. Now I want to make sure that I point out something here. We have to include the dividends in computing the net operating loss, and yeah, okay, I already got that. So we go forward, back 2 years and forward 20 years for any amounts that are left over. Okay. Oh, that's what I wanted to show you. Was right here. Notice that what? Green, see how I use green for green? Green Corporation may elect to forego what? The carry back option and just simply do what? Carry the loss forward. Okay, so I guess if they figure they're going to have what? Going to have different tax rates that are going to be maybe what? A little more stringent in the future, they could carry it forward, I guess. I'm thinking I'd want to carry it back so I get some cash right away, right? I don't have to wait until next year until I have income, and I'm thinking the tax rates are higher and I want to go ahead and take the loss then. But anyway, they have the choice between carry forward and carry back. Okay. All right, let's take a look at which of the following statements is incorrect. Okay, so let's take a look. A corporation may elect to forego the carry back and just carry forward. Now you see why I was making sure I showed that to you, because that answers this question, right? That's true. That's not incorrect. That's true. A corporation may claim dividends received deduction in computing an NOL. Yes, they did let us deduct that, right? An NOL is generally carried back 2 years and forward 20. That's the general rule, right? And then what? Unlike individuals, corporations do not adjust their NOLs for net capital losses or non-business deductions. No, we would still make what? Adjustments for the net capital losses. The only thing that they left out of the list of adjustments is going to be what? Is going to be the dividends received deduction. Okay, so none of these are true. Okay, good. Let's go ahead and let's take a look at this question. And we have what? Operating income here of $350. We have to bring in the dividend income for that, but then we get to do what? We get to back out, and in this case, since they are 25%, they're over that 15% threshold, they use the 80% factor. And so they get to do what? They get to deduct $40,000. They have their regular expenses from operations, and so we have what? $410,000 as the deduction. So the net operating loss is what? $10,000 here. And this was not a multiple choice question, so maybe the free response question that you see on your final might be something like this, where I'll ask you to go through and make these calculations to see what the net operating losses could be. Okay. Okay, good. Let's go ahead and let's take a look at the dividends received deduction. Yeah, I think we can do it in time. And then we'll stop there, and we'll pick up the rest of this after. Then we'll come back on Tuesday, okay? So let's just go ahead and let's take a look. And now these percentages make sense. What did I say? Less than 15%. And of course, they end up making a liar out of me. It's what? Less than 20%. That's when you fall in that 70% category, okay? 20% or more, but less than 80, you're in the 80% category. And then if you hold 80% or more of the stock, you can deduct the entire dividend. It's pretty much they're saying, hey, you paid a dividend to yourself, you don't have to pay tax on that, right? Okay, so let's just go ahead and see how the dividends received deduction is limited to the percentage of the taxable income of a corporation. For this purpose, taxable income is computed with regard to the NOL deduction, the domestic production activities deduction, the dividends received deduction, and the any loss carry back to the current tax year. So we would have to add those amounts back. The percentage of taxable income limitation corresponds to the deduction percentage. However, the taxable income limitation does not apply if the corporation has an NOL for the current taxable year. And you look at that and you're like, okay, what the heck is all that? Okay, so you look at the next slide, and I think it's a little easier in where we take it and we break it down into the steps that you should follow. Okay, so first, multiply the dividend received deduction by the percentage. Whatever the dividend was, times the 70%, 80%, 100%, whatever it is, right? Then, step 2, multiply taxable income by the deduction percentage. Again, 70%, 80%, 100%, whatever it is. So we've taken two numbers, the what? The dividend received by the deduction percentage, the what? The taxable income by the deduction percentage, and the deduction is limited to the lesser of step 1 or step 2, which either one of those yields the smaller number. That's your dividends received deduction, unless the what? Unless deducting the amount derived in step 1 would have given you a net operating loss. If that's the case, then go ahead and deduct the amount in step 1, and they call that affectionately the net operating loss rule. Okay, So let's just take a look at this example. That's not too bad to see up here. And I just kind of combined the book example with what I saw in the slides so that it could fit it sort of all on one screen here, because one page essentially, because the book had it split into 2 pages. So that's why it looked kind of funny. But this is all continuous example. And we have what? We have red corporation, we have white, we have blue corporation, right? Okay, now when you look at these guys, they have 400,000 gross income from operations, expenses from operations, and then we go ahead and take the dividends received, which is 200,000, and so that's giving me what? That's giving me 260,000, 180, 120. Okay, now step 1 is to take and they all got 200,000 of dividends. So we sit here and we take step 1, and it's a 70% because it's less than 20%. And so we have 140, 140, 140. Then what? Then we take the taxable income, which is including the dividend, before the consideration of the dividend received deduction, and we multiply those by the appropriate 70%. And we're supposed to take the lesser, aren't we, of those amounts? So which one is less, the 140 or the 182? 140. What's less, the 126 or the 140? 126. Now you look at this last guy and you sit here and you say, well, hey, man, why did they take 140 and clearly 84,000 is less? Well, what happens? If you were to go ahead and allow them to take the dividends received deduction, dividends received deduction is 140. If you take 140 from this guy, then he does have a what? Net operating loss of 20,000. And so for that reason, they go ahead and they let him take the dividends received deduction of 140, because it would have created a net operating loss, right? Okay. Now, if you were to go ahead and do what? Take 140 from everybody else. I don't know if I have to do this. You clearly what? Do not have a net operating loss. So that's why you went with the rule of taking the lesser of the dividend received deduction, or using the dividend received deduction percentage times my taxable income, right? Okay. Okay, I'll tell you what. I'm going to go ahead and let's see. I don't want to rush us through the 2 examples. So here's your homework. In addition to the things that I'm going to put up, go ahead and look at these couple of next questions, okay, that deal with this, just so I don't have to rush them and we can go through them properly. And then we'll finish up the slides for chapter 17 next time. And with the balance of our time next time, we'll start on the S Corporation chapter, whatever that is, okay? Okay, guys, I'll see you on... don't forget, Derek's here tomorrow, and I will see you on Tuesday. Please make sure that you signed in, and yeah, that's it. I'll see you on Tuesday. That's it. Thank you.